You clicked on this video because you are wondering if you should pay off your mortgage early. That is a heavy question because the answer determines whether you leave tens of thousands of dollars on the table or lock in a guaranteed return that might actually be a financial trap. By the end of this explanation, you will understand why paying off your debt early often costs you more money than keeping the loan and investing the difference, and how inflation is secretly working in your favor to subsidize that debt. Most people approach their mortgage as a liability that must be eliminated as fast as possible. They view the monthly payment as money lost to the bank and the total interest as a tax they must pay. This perspective feels safe. It feels like progress when the balance goes down to zero. But this mindset ignores a fundamental concept in finance called opportunity cost. Opportunity cost is the value of the best alternative you give up when you make a choice. When you choose to pay extra on your mortgage, you are choosing to give up the opportunity to invest that same money in the stock market. Here is the thing. The stock market has historically returned between 7 and 10% annually over long periods. A typical mortgage rate today might be 6%. If you pay an extra $1,000 toward your mortgage, you are effectively earning a guaranteed 6% return on that money. If you invest that $1,000 instead, you have a strong chance of earning 8 or 9%. The difference between 6 and 8% might seem small, but over 30 years, that gap creates a massive divergence in your total wealth. You are essentially betting that your mortgage rate will stay higher than the market average for the entire remaining term of the loan. Now consider this. Inflation acts as a hidden asset for the borrower. Inflation is the rate at which the purchasing power of your currency decreases over time. When you take out a 30-year fixed mortgage, the amount you pay every month stays the same in nominal terms. It does not change. However, as inflation rises, your wages typically rise with it. This means that 30 years from now, the monthly payment will feel much smaller relative to your income than it does today. You are paying back the bank with dollars that are worth less than the dollars you borrowed. The bank loses value on the loan while you retain the full value of the house. By paying off the loan early, you are refusing to use this inflationary leverage to your advantage. You are paying back the bank with full value dollars instead of devalued ones. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. There is a specific trap for high earners, particularly those in engineering or tech fields, that makes this decision even more critical. Imagine you earn a high hourly wage. If you decide to pay off your mortgage early, you are essentially trading your high-value labor hours for a guaranteed return on the money you used to pay down the debt. You are working extra hours to earn money that you then give to the bank at a low interest rate. Meanwhile, if you kept that money invested, it could compound at a higher rate without you having to work a single extra hour. The math suggests that your time is better spent earning high wages and investing the surplus rather than trading your labor for a low-yield debt reduction. This leads to a failure mode known as a liquidity floor. When you pour extra money into your home equity, that capital becomes illiquid. You cannot easily access the money you have built up in your house without taking on new debt or selling the property. If an emergency arises or a high-conviction investment opportunity appears, that cash is locked up in the walls of your home. By keeping the mortgage, you maintain liquidity. You have your cash available to deploy where it can do the most good. You are not forced to sell your home at a bad time or take out a high-interest credit card to solve a problem. The debt-free mindset often traps your capital in an asset that does not generate cash flow, whereas an investment portfolio generates returns that can be reinvested or withdrawn as needed. We also have to talk about the psychological bias that drives this decision. Many people feel a deep emotional relief when a loan balance hits zero. This feeling of being debt-free is powerful. It feels like a victory. However, this emotional victory often overrides the principle of capital efficiency. Capital efficiency means using your money where it generates the highest return. When you prioritize the emotional relief of a zero balance, you ignore the cost of that capital. You are essentially making an arbitrage bet that the mortgage rate will remain higher than the market average for the entire remaining term. If the market outperforms your mortgage rate, you have lost money. If the market underperforms, you win. But the odds are historically stacked against the borrower who pays early. Furthermore, for many high-income earners, mortgage interest is tax deductible. This reduces the effective cost of the loan even further. If you itemize your deductions, the government is subsidizing a portion of your interest payments. By paying off the loan early, you lose that tax shield. You are paying more in taxes and less in interest, which further erodes your financial advantage. The decision to eliminate debt early is not just a math problem. It is a trade-off between the certainty of guaranteed debt reduction and the potential for higher market returns. The certainty feels good, but the math often favors the potential. It is a decision to forgo the benefits of inflation leverage and tax deductions. It is a decision to lock your capital in a way that reduces your flexibility. For the rational, long-term investor, the optimal strategy is often to carry the mortgage and invest the surplus. This approach maximizes wealth accumulation by leveraging the market's historical growth and the eroding power of inflation. However, this strategy requires a specific type of investor. It requires the discipline to invest consistently regardless of market volatility. It requires the ability to handle the psychological stress of carrying debt while watching the market fluctuate. If you are risk-averse or if you have liquidity constraints that make cash flow critical, paying off the mortgage might be the right choice for your peace of mind. But if you are a rational investor focused on long-term wealth, you should view the mortgage not as a burden to be eliminated, but as a tool to be managed. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.